Hi class, a pleasant day to all of you. This is your Professor Dan, and in this video we are going to discuss the continuation of dissolution. And we are already in part 3, which is admission of new partner. And what we are going to discuss is that the new partner will invest in the partnership. Okay? So in the previous lecture video, we have discussed the first way of admitting a new partner, wherein the new partner will buy the interest from the existing partner. But here, the second way is that the new partner will invest in the partnership. Okay? The new partner will no longer have transaction with the partners, but rather the new partner will make the transaction with the partnership. Okay, so the transaction is between the new partner with partnership. So if this is our new partner will negotiate with the business itself. Okay. So investment by the new partner will increase the assets and the partner's equity. So to illustrate that, if this is the accounting equation of the partnership, the investment that will be made by the new partner will increase the asset of the partnership. And accordingly, the new partner will be given the corresponding capital in the partnership. Okay? So in this case, the partner made a contribution of 300,000 if the new partner gave 200,000 cash, and in return, the partnership will give the new partner a capital of 300,000. So in this situation, there will be a change in the structure of partners' equity and total equity will increase. Okay, so there will be a change in the structure because uh, the in addition to the existing structure of the existing partner, then the additional capital will be given to the new partner. So there will be an increase in the capital structure of the partnership. That increase in capital is due to the contribution made by the new partner. Accordingly, there will be a change in the profit and loss ratio of all partners. So, considering that there is an additional capital, then the new partner will be given a certain percentage of the profit of the partnership. So there will also be a change in the existing profit and loss ratio of the existing partner. So there is a need to revise the profit and loss ratio. The new partner's interest is based on the agreed capital, which can be higher or lower than the contributed capital. Class, I would like to emphasize that if the new partner contributed 300,000, it does not exactly mean that he will be given 300,000. It can be higher or it can be lower. The difference between the amount contributed by the new partner and the capital given to the new partner is what you call bonus. So here class, if there is a difference between the new partner invested amount, which in this case 300,000, with the capital interest in the partnership, the capital interest that will be given to the new partner, if there is a difference, it is called bonus. And class, in this illustration, the new partner invested 300,000. However, the new partner was given only a capital interest of 280,000. So in this case, the new partner investment is more than the capital interest, and there's a difference of 20,000, and that 20,000 difference will be given as bonus to existing partner. EP stands for existing partner. Okay? However, in situations like the new partner capital that was given to him is 340,000 for 300,000 investment. So in this kind of situation wherein the new partner investment is less than the capital, so the difference, which in this case 40,000, that is bonus that will be given to the new partner. Okay? Okay, class. Uh, in addition, class, the difference, which is bonus, affects the capital of existing partners. Okay, take note of that. Now, class, we will be discussing accounting terminologies on the admission of new partners' investment in the partnership. Okay, so what are the accounting terminologies? The first one is the total contributed capital. So total contributed capital, we will abbreviate it, or the acronym is TCC, is the sum of capital balances of existing partners plus the actual amount of investment of the new partner. So the balances of existing partner plus the amount invested by the new partner. So that is our TCC. So TCC, existing partner total capital plus new partner's investment. The next terminology is total agreed capital. Okay? The total agreed capital is the total capital of the partnership based on the total capital credits given to each of the partners, both existing and new partners. So this is the percentage given to the new partners, okay, in terms of capital interest. For example, this partner will have 20%, this partner will have 40%. So these are the capital credits given to each of the partners. This is being agreed by all partners. We will illustrate this. The total agreed capital is equal to total contributed capital in what you call the bonus method. Okay? If there is a difference between the new partner's invested capital, as we have discussed in the previous slide, with the credits given, uh, capital credit given to the new partner, that difference is what you call bonus, right? So in this situation wherein there is a bonus, we will assume that the total agreed capital is equal to total contributed capital. Okay? Bonus method means that existing partner or new partner will receive a bonus depending on the situation. For illustrations, total agreed capital can be given or to be computed. In our problems, the total agreed capital can be given or it is stated, or we have to compute that. So in case that we are going to compute the total agreed capital, the way to compute it is this. Total agreed capital is equivalent to the amount of new partner interest. We are referring to the amount of the new partner interest that was given to him over the percentage of new partner interest. What is the equivalent ratio of that amount? Okay, that will give you the total agreed capital. The third terminology that I would like to share with you is capital credits. And we are going to use the acronym CC, capital credits of new partner. Okay? Capital credit is the amount of capital interest of the new partner in the partnership. It is computed as percentage of total agreed capital. Okay, so if you want to compute the amount, you have to know the percentage of new partners' interest, multiply that with the total agreed capital. I am presenting this to you because there is there are problems wherein the amount is given and the total agreed capital is given. So you have to get the percentage, okay? Or in this case, like here, in doing the, what do you call this? The algebra, okay? You can, one of the uh, item here can be unknown, okay? So you have to know this equation. Okay, so class, take note that this CC amount will be the amount of new partners' interest. So it's the same. The amount of new partners' interest, this is the capital credits of new partner, okay? Okay, class, let us move on. To compute the total agreed capital, let us have an exercise. Let us compute the total agreed capital. So again, the total agreed capital, the formula is amount of new partners' interest over percentage of new partners' interest. Amount of new partner interest is also the same as capital credit of the new partner. So if the total agreed capital is equal to total contributed capital, we are assuming this situation under the bonus method, meaning we are giving a bonus. There is a difference. Bonus arises when there is a difference between the new partner's contribution as against the new partner's interest. However, we can compute the total agreed capital, okay, and for illustration purposes, we will have this situation. If capital credit of new partner is 25,000, compute the total agreed capital for the following capital interest of the new partner. So here, the formula, the amount of new partner's interest, it will be here, for example, the interest of the new partner is 1/3, 0.4, which is 40% or 25%. How are we going to compute the total agreed capital? So for 1/3, 25,000, which is the capital credit of the new partner, over the percentage of 33.33%, okay, or divided by 1/3 on this, that will give you 75,000 as your total agreed capital. So if the percentage of partner's interest is 0.4, that is equivalent to 40%. So doing the mathematical calculation, 25,000 divided by 40%, you will have 62,500. And for number 3, 25,000 over 25%, doing the mathematical calculation, you have the total agreed capital at 100,000. Okay? Take note of that. Class, let us discuss again asset revaluation. We have discussed asset revaluation in the previous lectures. And we have learned that asset revaluation is the increase or decrease of the assets. In this lecture, which is the investment by new partner, it can be determined by comparing total contributed capital with total agreed capital. So if total contributed capital is the same as total agreed capital, if they have the same amount, there is no asset revaluation. However, if total contributed capital is less than total agreed capital, we have an asset revaluation, which is an increase in asset. Okay? If total agreed capital is higher, there is an increase in asset. So in this case, we are going to increase the capital of existing partners. Okay? Because asset revaluation is only given to existing partners. Okay. If total contributed capital is higher than total agreed capital, then there is a decrease in asset. So decrease in asset, we are going to decrease the capital of existing partners. So again, to be fair, if there's an increase, give the existing partners because the increase arises without yet the new partner. And here, if there's a decrease in asset, then the existing partners will shoulder the decrease, okay? Because the decrease arised uh, without the new partner yet. Okay. So class, let us move on. Let us now discuss bonus. What is bonus? Bonus is the difference between the new partner contributed capital. Again, it is being emphasized. The difference between the new partner contributed capital with the capital credit given to the new partner in the partnership. Okay? Bonus exists when new partner actual investment is not the same with the new partner capital credit. So if these two are the same, there is no bonus. So it will only exist when there is a difference between actual investment and the capital credit of new partner. Bonus to new partner, okay? If the new partner investment is less than the capital that was given. So a higher capital given to the new partner, then there is a bonus to new partner. Bonus to existing partner if the new partner investment is higher than the capital given to the new partner. Okay, so the bonus will be given to the existing partner. I just want to emphasize because we are going to discuss that or include that in our discussion in these following illustrations. Okay, first one, case one. New partner contribution is equal to capital interest. So the new partner contribution is the same with the capital interest. Okay, given Rebecca and Stella are partners with capital balances of 400,000 and 200,000 respectively. They share profits in the ratio of 3:1. Okay? So existing partner profit and loss ratio 3:1. Okay? And in percentage, it would be 75%, 25%. Take note we are using the same given from the previous one. Now, the total contributed capital. So based on our discussion, it will be the capital balances of existing partners plus the new partner's contribution. So let us first indicate the capital balances of existing partners. And the situation for the new partner is that the partners agreed to admit Bert as partner. Bert is to invest cash of 200,000 for a 1/4 interest on total agreed capital of 800,000. Okay, class, here we are, the partnership is admitting Bert as a new partner. And Bert will invest cash because total contributed capital is the investment, total investment, the existing capital structure plus the actual investment made by the new partner. So the total of this now is 800,000. Okay? So class, the next thing that we are going to determine is the total agreed capital. By the way, class, if we have problem like this, it's best that you are going to use Excel, okay? With this format in Excel. So the total agreed capital, is it given? Yes, it is given. Total agreed capital of 800,000. Okay, 800,000. Next is that we have to compare the total contributed capital and the total agreed capital to determine whether there is an asset revaluation. So if the total contributed capital and total agreed capital are the same, there is no asset revaluation. If the total contributed capital is higher, okay, than the total agreed capital, then there is an asset impairment or decrease in asset. However, if the total agreed capital is higher than the total contributed capital, there is an increase in asset. So in this illustration, there is no asset revaluation. So we don't have to prepare any adjustments or recording on that. The next thing that we have to do is find the new partner's percentage of interest or the capital credit. We are going to find the percentage here. So here, the problem indicated that the new partner will be given a 1/4 interest. And 1/4 would mean, in terms of percentage, it is equivalent, 1/4 is equivalent to 25%. Okay? So in this case, it is giving us an idea that the capital structure will not be based on the uh, capital balances, but based on the agreed ratio, since that Bert is already given an agreed ratio of 25%. Okay? That is his share. So now let us compute the new partner's capital or the capital credit. Okay, the new partner's capital credit, how much? Okay, we are going to compute the new the new partner's capital credit based on the percentage of interest times the total agreed capital. Okay, if you will recall the discussion that we had from the previous slide. So 25% times 800,000, okay, 25% times total agreed capital of 800,000 will give you 200,000. Okay, what will be the next thing that we have to do? We have to determine the bonus. And in determining the bonus, we have to compare the actual investment, which is 200,000, with the contributed capital credit. And the capital credit is 200,000. So we are comparing the 200,000 with the capital credit of 200,000. So in this case, there is no bonus, zero. Okay, class? So class, now we are ready to record this. Okay, so here we are recording the investment made by Bert. So the investment made by Bert is 200,000, and Bert was also given a capital credit of 200,000. So what we will be recording is the capital credit given to Bert of 200,000. So we debit cash of 200,000 and credit Bert capital 200,000. Okay? And now let us get the profit and loss ratio. Okay? Take note that the new partner Bert was given 25%. Okay? So it does not mean that we will be computing the profit and loss ratio based on capital structure. So the revised capital interest will look like this. Rebecca has 400,000, Stella has 200,000, and Bert 200,000. Okay? So for a total of 800,000. However, in this kind of situation, to compute the revised profit and loss ratio, we will be, because it's not stated that we are going to compute it based on the revised capital interest. So with this, we are going to give birth 25%. And after giving birth 25%, there is a leftover, okay, of 75%. And this 75% will be shared by Rebecca and Stella. So 75% of this 75% will go to Rebecca. 25% of this 75% will go to Stella. So 75% times 75% is 56.25%. 25% times 75% is 18.75%. So this will be the revised profit and loss ratio. Okay, let us move on. And here, the new partner contribution is more than capital interest. So case 2. So the new partner contribution is more than capital interest. So the existing partner based on our what was given from previous slide is this. So now the condition is that Bert is to invest cash of 250,000 for a 1/4 interest on the total agreed capital of 850,000. So again, we have to determine first the total contributed capital. By the way, I just put the ratio here on their respective names for space to accommodate the other things that we need to place here in this slide. So new partner, okay, will invest 250,000. So the total contributed capital is 850,000. So again, the next thing that we have to determine is the total agreed capital. And based on the condition, the total agreed capital is also given at 850,000. Since that TCC and TAC are the same, there is no asset revaluation. The next thing that we have to determine is the percentage of interest. Okay, capital credit in terms of percentage. So in terms of percentage, Bert will be given 1/4. So that is still 25%. Okay? And now, let us determine the new partner's capital credit. And the new partner's capital credit, okay, will be 25% of 850,000. So 25% of 850,000, that will be 212,500. So you take note, class, that Bert contributed 250,000, but he was only given 212,500 as his capital credit. So now we have to compare the two. So we have to determine if there is bonus by comparing the actual investment and the capital credit. So here, 250,000, compare that with 212,500, there is a difference of 37,500. Here, the contribution is more than the capital credit given to Bert. So in this case, these 37,500 will be shared by the existing partner, Rebecca and Stella. And the way they will share this is that 75% will be given to Rebecca. 75% of 37,500 is for Rebecca. And 25% of 37,500, which is equivalent to 9,375, will be given to Stella. Okay? And now we can record the admission of Bert as partner. we will debit the contribution of Bert in the amount of 250,000 and give Bert the capital credit of 212,500. And then the excess, which is bonus, given to Rebecca and Stella. So the capital will be recorded. I mean, the bonus will be an increase in the capital of Rebecca and Stella. Okay? So we will record the bonus by increasing the capital of the existing partner. Okay? And now, class, we are going to get the revised capital interest. So now these are the revised capital interest of Rebecca and Stella. 400,000 plus 28,125. Stella 200,000 plus 9,375. And the capital interest of Bert, which is the capital credit of 212,000. So the total of these three is 850,000. Okay, with regards to the revised profit and loss ratio, the problem did not state that the ratio will be based on capital. The problem indicate that Bert was given 1/4 interest, so Bert will have 1/4, which is 25%. Again, the difference, the ratio of given to Bert is 25%. So the leftover ratio that will be shared by Rebecca and Stella is 75% because we have to have 100% here. So 75% times 75% for Rebecca, that will be 56.25%. That will be the profit and loss ratio for Rebecca. And Stella will have 18.75%, 25% of 75%. Okay? Next case. New partner contribution is more than capital interest. Okay? So here, the existing partner, we have the contributed capital. And the condition is that Bert is to invest 400,000 for a 300,000 capital interest. So the new partner contribution is more than the capital interest. Okay. So here, class, it's basically the same from previous one. So let us see what are the differences. Okay. So because in the previous one, we also had an illustration that the new partner contribution is more than the capital interest. Okay. But here, it's the same thing. We have new partner contribution is more than the capital interest. So our situation is that Bert is to invest cash of 400,000. So the total is 1 million. Class, if you will note that the total agreed capital here, in this case, is not given. In case 2, the total agreed capital was given. But here it is not given. Okay? So let us first determine what are the other information that we can have. The new partner's percentage of interest is not given also, not stated. Okay? And however, the new partner's capital in terms of amount there is 300,000. Okay. Take note, class, that the new partner's capital, okay, that was given to Bert is 300,000. And Bert is only contributing 400,000. So obviously, there is what you call a bonus. So under bonus method, our total contributed capital and total agreed capital is equal. Okay, under the bonus method, because we were able to establish that there was a bonus. So in this case, our total agreed capital is the same as total contributed capital of 1 million. Okay? So next is that, okay, um, to get the percentage of interest, we can now divide 300,000 by the total agreed capital. We cannot do that before because we do not know the total agreed capital. Since after computing the bonus and in our assumption, total contributed capital is equal total agreed capital under the bonus method. Since there's a bonus, so our total agreed capital is 1 million. So now we can get the percentage of interest because this is now available and our new partner's capital is available. So relating the two, our percentage of interest is 30%. Okay? Now we have to distribute, okay, the 100,000 bonus. This 100,000 bonus, Bert contributed 400,000. He was only given 300,000. So obviously this 100,000 will be given to Rebecca and Stella. Okay? With in the ratio of 75%, 25%. Okay. So now we can record the investment made by Bert. We will receive cash of 400,000, debit cash, and credit Rebecca capital, additional capital for Rebecca of 75,000, additional capital of 25,000 to Stella, and Bert capital was given 300,000. So this will be the entry to record the investment in the partnership by Bert. Okay, now to get the revised capital structure, we will have 475,000, adding the two, for Rebecca, and Stella 225,000, and Bert will be given 300,000. Okay? And we have calculated that the interest of Bert, the profit and loss ratio of Bert is 30%. Okay? So now the remaining percentage, if Bert is given 30%, so the remaining percentage is 70%. So this 70% will be shared by Rebecca and Stella on this profit and the original profit and loss ratio. So 75% times 70% will give you 52.5%. 25% times 70% will give you 17.5%. Okay? Let us move on for case number 4. So case number 4 is new partner contribution is less than capital interest. Okay? So it means that the capital interest is higher than the new partner contribution. So this is our given. And this is our condition. Bert is to invest cash of 240,000 for a 1/3 interest on total agreed capital of 840,000. So Bert is our new partner investing 240,000. So the total contributed capital is 840,000. And the total agreed capital, it is given at 840,000. Okay? So the next thing that we have to determine is the asset revaluation. Since that they are the same, no asset revaluation. So the next thing is the percentage of interest. The problem provide as the percentage, which is 1/3. And 1/3, okay? And now, let us determine the amount of this 1/3. So, 1/3, since the total agreed capital is given, so we will multiply 1/3 times 840,000 and we will get 280,000. So we are going to compute now the bonus by comparing the actual investment with the capital credit given to Bert. So in this case, 240, compare that with 280, there is a 40,000. Since that the capital credit is higher, this 40,000 will be given to Bert. So class, the bonus that will be given to Bert will be deducted from the capital of the existing partner. So 40,000 times 75%, that will be deducted from Rebecca's capital. 40,000 times 25%, that will be deducted from Stella's capital. Okay? So here, this will be our entry. Okay, we will debit cash of 240,000 and we will debit Rebecca capital to reduce the capital of Rebecca by 30,000, which is her share from the bonus, and deduct Stella's capital of 10,000, which is her share from the bonus given to Bert, okay? And credit Bert capital of 280,000, okay? And if we are going to get the revised capital interest, this is how it will look like. So 400,000 minus 30,000, 370,000. 200,000 minus 10,000, 190,000. And Bert will have 280,000. And Bert was given 33%, 33.33 or 1/3. Okay, so the remaining percentage to be shared by Rebecca and Stella is 66.67%. So 75% times 66.67%, that will be 50% of or the profit and loss ratio of Rebecca, and 25% of 67%, that will be 16.67%. Okay, so this is the revised profit and loss ratio. Okay, let us move on. Here we have case 5. Here we have new partner contribution is less than capital interest. Okay, so here we have the given. So this is our condition. Bert is to invest cash of 300,000 for a 50% on total agreed capital. Bonus is to be given. So it is indicated that bonus will be given. So class, this is basically the same, but there will be differences in terms of the given amounts. Okay, so here Bert will invest 300,000. So the total contributed capital is 900,000, adding the 3. Then let's get the total agreed capital. Okay, it is not given. The total agreed capital is not given. However, there was a statement here that bonus is to be given. So in this case, the total contributed capital and total agreed capital are the same. Okay, so we can now put that the total agreed capital is 900,000. So the percentage of interest, new partner's percentage of interest is 50%. And since the new partner's capital, the amount, since that we have the total agreed capital and the percentage, so we can compute right away that the new partner's capital is 450,000. And let us compute the bonus. Bert invested 300,000. He was given 450,000. So there's a bonus of 150,000. And this bonus will be for Bert because he was given higher amount of capital interest. So this 150,000 will be shared by Rebecca and Stella, 75% the share of Rebecca, so there will be a reduction on her capital by 112,500, and 25% of 150,000 is 37,500. Okay, so we can now record this. We will receive cash from Bert of 300,000 and debit cash of 300,000. Debit Rebecca capital of 112,500 and Stella capital 37,500, and credit Bert capital of 450,000. And to get the revised capital interest, okay, and then the revised profit and loss ratio. So Bert was given 50%, so the remaining of 50% will be shared by Rebecca and Stella. 75% of 50% is 37.5%. 25% of 50% is 12.5%. Okay? Okay. This is the last illustration. So this is implied asset revaluation and bonus. Here we have the total contributed capital from our given. Then Bert is to invest cash of 300,000 for a 20% or 220,000 interest on total agreed capital. So the new partner Bert will invest 300,000. So the total contributed capital is 900,000. Let us get the total agreed capital. The total agreed capital is blank. Okay. So next is the percentage. Percentage is 20%. Okay. And after this is the new partner's capital of 220,000. Since there is a difference between 300 and 220,000, we know that this is a bonus method. So under bonus method, oh, by the way, if this is what you call implied. So here there is an implied, okay? Since 20%, the 220,000 represents 20%, okay? So we can calculate the total agreed capital, okay, based on this. So here, 220,000 divided by 20, we have 1,100,000. Okay, even though that it resulted to says bonus that will make this equal. However, there is you already have the percentage of interest, which is more or less exact. The total contributed capital is equal to total agreed capital. That is only an assumption. Okay. But here you are given already the percentage and the amount, so you can calculate the total agreed capital. So 20% of 1,100,000 will give you 220,000. Okay, so it's exact. So in this case, you have to record, because there is a difference between total contributed capital and total agreed capital, you have to record the asset revaluation. There is an asset revaluation. So in the asset revaluation, you have to add to the capital of the existing partner. You have to get 75% of 200,000, that will be 150,000, okay? And then 25% of 200,000, that will be 50,000. And then this 220,000, there is a bonus of 80,000. You have to compare. Oh, by the way, this is the entry for the asset revaluation. And now for the bonus, there is a bonus of 80,000. And this bonus of 80,000 will go to the existing partner because he was only given, Bert was only given 220,000. Okay, so 75% of 80,000 is 60,000. 25% of 80,000 is 20,000. So to record now the investment of Bert, we will debit cash of 300,000, okay, and credit Rebecca capital of 60,000, Stella capital of 20,000, and Bert capital of 220,000, okay. And to get the revised capital interest, we will have to add this, and under Stella, we have to add that, and new partner Bert will have 220,000 for a total of 1,100,000. Okay. This is the difference with the previous one, because in the previous one, we assumed that total contributed capital and total agreed capital are the same because there was a bonus method. But in this case, since that we were given these two, the percentage of interest and the amount, we can determine the exact total agreed capital. Okay. So to compute the revised profit and loss ratio, Bert will have 20% and the remaining 80% will be shared by Rebecca and Stella. Okay, that's it for this video. Let me know if you have questions. Bye for now and have a great day.